Thank you for joining FTW Investments April Investor Webinar Series. And like I mentioned beforehand, everybody that's joined this gets priority access to our brand new masterclass special training that Parker, Corey, and myself spent a ton of time on. And I think it's going to add a lot of value to your decision-making, your framework, and creating a new mental model for you to evaluate investing through. So let's jump right into this month's webinar series where we're educating around passive investments and private placements in particular. This is a document that we have put together that most of our investors have. If you're interested in this document, just reach out to me and I'll get it sent over to you. This guide is for informational purposes only. This is not intended to be a general solicitation or a securities offering of any kind. And so this, again, is for educational purposes, and we just have to make all of those disclaimers. About FTW, so FTW Investments is a private equity real estate firm based out of Kansas City, Missouri. We have seen a decent amount of growth over the last 12 months. We're closing in on 1,000 units. Our team is growing. We're 7 people strong. We're very excited about our positioning in the market and where we're headed. And I think that, the difference between FTW and most of the other potential investing companies out there is, we're real estate operators, developers, and brokers that need to bring in outside capital, not outside capital that's being aggregated, putting into real estate developers' deals. So we always say that there's the difference between being in the business of real estate investing and being a real estate investor. We're definitely in the business of real estate investing. About this roadmap. So what are you going to get out of today's training? Well, this is basically a roadmap to help you navigate the world of real estate private placement memorandums. And we divided this up into 4 sections. We're going to explain private placement and private investing. We're going to explore private real estate investing in depth, including commonly used terms. And we're going to reveal the documents that you should expect in connection with those private placements. And lastly, we're going to reveal questions that you should ask the general partner when exploring a private placement. And I think this is going to be extremely beneficial for all of you. So what is a private placement? It's an offering of securities exempt from full SEC registration requirements. This offering can be of debt or equity. Most of the time, FTW investments are of the equity type. And these are made directly by a company or that's offering debt or equity through limited liability company interests. So what that means to you is, and when we go to purchase our real estate, we're purchasing them in a business, and you are purchasing shares of that business. And you get all the benefits of investing in real estate without having to deal with the toilets, the tenants, and the trash. Why private investing? We talk a lot about this in relation to the alternatives and private equity and private real estate funds. And what we're going to focus on is private real estate funds. The Jobs Act of 2012 really opened this up, and the Obama administration allowed for real estate developers to start bringing outside capital in if they had a pre-existing relationship with them, or if it's a 506c offering, allowing for accredited investors. Most of our offerings, we have elected to utilize the 506b, which allows us to bring in sophisticated investors who do not meet the accredited status yet, but we have a pre-existing relationship with. So how are these structured? Private equity is structured in corporations, limited partnerships, but most of the time we utilize limited liability companies. Here's the traditional ownership model. Okay, so we typically have a preferred return, which is a specific rate of return before any other profit distributions are made to the investors. So our limited partners, our passive investors, you are receiving a preferred return of typically of 8 to 9%. And then above that return hurdle, we split the profits, typically 70% to our limited partners or our passive investors and 30% to the general partners, or myself and Parker and Corey, or FTW Investments, Freeman, Tuck, and Webb. And there's a lot more complicated waterfall models, depending on what type of project it is. Typically, that's the structure that we're going through. From an exit strategy standpoint, we get this question quite a bit. Typically, we have a 5 or 10-year hold on our real estate investments. And depending on the type of project, if it's a value add investment, then we have the opportunity to potentially return capital through a refinance and or the sale of the property. Sometimes we have longer holds like 10 years, especially when we're locking in long-term debt or assuming a loan on a project. We've done both. We talked a little bit about this already, but there is a difference between an accredited investor and a sophisticated investor. Accredited investor, the qualifications are there, and if it is a 506C, then you have to have all accredited investors. Again, most of our projects are not structured that way. They're structured as 506Bs, which allow us to bring in sophisticated investors that do not meet the accreditation qualifications yet, but we have a pre-existing relationship with. All right, let's get into some real estate investing. So, some terms to know. So net operating income, it's the income from the property, except for all the operating expenses, excluding CapEx, debt service, depreciation, and the debt or amortization. So for example, an apartment community with a total gross income of $2 million and a total operating expense of 1.5 has an NOI or net operating income of 500,000. The other term here is capitalization rate, and it's typically referred to as a cap rate. It's a measure of valuation. A cap rate is calculated by dividing the property's NOI by either the current market value or acquisition cost of a property. So for example, an apartment community with an NOI of 720,000 that was purchased for 12 million has a cap rate of 6%. Internal rate of return. This is a return on investment metric that we utilize quite a bit. And it's the intrinsic rate of return that's expected to be derived from a particular investment, taking into account timing and expected cash flows. So even more detail, the IRR is the rate that makes the net present value equal to 0. NPV is the difference between the present value cash inflows and the present value of cash outflows over a period of time. And so you'll see us have IRR and AAR, or average annual return, on our projects quite a bit. So there's an example here. And if you want to learn more about the differences between IRR or AAR, simply reach out to me. I'd be happy to spend some time with you on that. So here's some more terms. The rent roll is a detailed spreadsheet, which includes the detailed rent payments and tenants information. Underwriting, if you ever hear us say underwriting, Parker's typically doing most of our underwriting. It's the process of financially evaluating a property to determine the projected returns and an offer price. Our rent premium is the increase in rent after performing the renovations to the interior or exterior of a property. Pro forma is a document that you're going to get, which is the projected budget and income of a property with itemized line items for the income and expense for the next 12 months and next 5 to 10 years. And then preferred return, which we talked about. It's a profit distribution preference whereby profits, either by operations, sale, or refinance, are distributed to one class of the investor before another until a certain rate of return of the initial investment is reached. And so again, most of ours are 8 or 9% on our projects. So we get this question quite a bit as well. What's your investment thesis? And so we put together the 4 real estate investment strategies that we're going to talk about. So core and core plus. These are 2 asset classes that we have not typically done a lot of projects in, but core investments are typically low risk and require no improvements or active management. Along with the low risk, they also offer lower returns than other investment types. And you have core plus, which are low to moderate risk. And unlike those core properties, these properties offer the opportunity to improve the cash flow through slight improvement or management improvements by improving the tenant profile. So when we talk about core and core plus, we're talking about class A and class B apartments or other types of investments. Where we focus most of our time on is the value add and the opportunistic. Now, value add investments are considered moderate to high risk, and those value add properties have underperforming cash flows and occupancy, but the potential to see big bumps in those. And so we do this through an operational efficiency or through renovation of the project and bringing those rents back up to market. An opportunistic project are the riskiest. So these are redevelopment opportunities. So taking an old building that's vacant or has a different use and transforming it into something, or something completely different, or even, just renovating the whole project. We've done one or two opportunistic projects. And before I move on, inside of value add, we have three different levels of value add. We have light, medium, and heavy. And we've done all three of those. So light value add is going to be cosmetic. Medium, you're going to have cosmetic and some mechanical, electrical, plumbing. And then heavy value add, we're going to have a lot of mechanical, electrical, plumbing, and a big construction budget. In the right hands of the right sponsors, private real estate investment funds can achieve value add level returns with core levels of risk. And that's what we're going after. Typically, you'll hear us talk a lot about margin of safety because we're value investors. And so we reduce this risk of the value add returns through skilled management, established infrastructure, and our proprietary analysis system. And so this is where the experience really comes into play. With real estate, you have to have knowledge, experience, and relationships. And we put this into intellectual capital and break that out into structural, human, and relationship capital. If you would like for me to send you a graphic that we have on that, I'd be happy to do that as well. So here's some common risks of real estate private placements. Liquidity. Interest in these deals are illiquid, and so they can't be sold or exchanged quickly or easily like public stocks or bonds. And they're long-term investments. Typically, these have 5 to 10-year holds, and so we're not subject to market swings like in the traditional equity markets. Valuation. Sometimes deals are hard to evaluate, especially if you're not involved in that market. Thankfully, FTW is highly specialized in the Kansas City and Midwest markets, and that's where we focus on. We have leverage. Obviously, we have debt. Now, our investors are not usually signing on the debt. It's usually FTW that's signing on the debt and making sure that we are guaranteeing that debt. So you don't have a ton of risk when it comes to being on debt for these projects. So we're going to get disclosures. You're going to have, these are some other, risks that you need to think through. The management of the projects are so important, and being comfortable with the sponsors is a crucial component of having a great partnership with somebody. But the limited required disclosures, we have our own reporting that we have to obviously provide to you, but it's not the same level of reporting that you're going to get from a publicly traded company on the stock market. We do monthly reports as well as detailed quarterly financial reports. Our private placement memorandum. And so before you invest, you need to understand what a PPM is, or a private placement memorandum. And basically it's a document that allows you to evaluate all of the risk associated with that project. And the due diligence is crucial to a successful investment as well. So here's some general investment guidelines. Our management fees, management compensation, and then the capital allocation. This is how kind of, FTW is obviously compensated in these projects. And, we have to disclose all of our fees in the private placement memorandum. Again, here are some real estate specific alignment of objectives and key factors that go into thinking about an investment, and something that you should evaluate whenever you're talking to a sponsor. All of these factors are very important when evaluating a real estate deal, and your sponsor should be able to talk through all of these different things. You got your legal terms and your strategy, you have your ROI, you have the management compensation, what's the exit plan, what kind of reports am I going to get, and what do the disclosures look like? Let's move on to the questions to ask a general partner. So these are questions that we get, quite a bit, and we wanted to put them out here because I think it's very important to think through. So how much experience do you have? What kind of fees do you have? Is the company structured legally to minimize the tax benefits? Are there salaried employees? What's the transparency look like? Are there middlemen brokers getting a cut of my investment? So I'm happy to answer all of these questions. We wrote an article just on this, and so we can evaluate this, but I'll send you the article that we wrote. It's called 17 Things to Think About with FTW Investments. And I go in detail in all of these questions. So I know that was a high level overview of this private investment roadmap, but what you need to know is to evaluate a project, you have to understand what goes into that evaluation. And so what we have done is put together a more detailed masterclass that gives you 10 critical success growth factors to evaluate when you're thinking about an investment opportunity. This roadmap right here that we just went through is more around building the trust, building the relationship with the people behind the real estate. So more of a human and relational type of roadmap. The masterclass that you're going to have access to is going to give you a mental model that allows you to evaluate any type of investment. So we've identified the 10 critical success growth factors, and we've detailed how real estate approaches those and how FTW approaches those as well. So if you're interested in signing up for that, click the link, sign up. I don't think you'll be disappointed. We spent a lot of time on that masterclass, and we're here to bring a ton of value to you. So FTW Investments is here for the long haul. We've had a lot of success over the last 12 months. We're uniquely positioned in our marketplace to bring you risk-adjusted returns that allow you to create cash flow and have a hedge against inflation. If you want to learn more, just reach out to me, Logan Freeman at FTW Investments, and I will talk to you very soon.